You're watching us here on Trading Hour, live coming to you from the CNBC-TV18 Motilal Oswal studio. I'm Mangal Malu. With me, as always, Hormas Patakia as well as Ritu Singh. Looking good for the market today. In fact, from yesterday's low, we've seen a recovery of almost 200 points on the frontline index.
Yeah.
The Nifty holding above that 26,050 mark. And the good part today is that it's been led by all three engines. We have the Nifty Bank, which is doing well, though it's a smidge off the highs ahead of the RBI policy meeting.
Yeah.
We have the IT index, which has been doing well. And alongside that, we also have Reliance, the big weight on the frontline index that comes up for you at the high point of trade. At some point, the contribution chart comes up, and that tells you the top contributor on the Nifty on the way up today has to be Reliance.
Well, yes, Nifty, IT, metal, all of them, in the green today. Only pharma and media are the two ones that are, dragging a little lower in trade. But yes, let's get to Hormas for the buzzing stocks of the day. Hormas?
The broader markets are doing well in today's session, and that is something that will come as a sigh of relief for the bulls, because the broader market breadth was a bit of a concern over the last few trading sessions. And you start off with the movers today. The Nectar Life Sciences is among the top gainers on the small cap index today, 17% higher on the stock. And the stock had a bit of a whiff of an impending share buyback coming in. In the last 5 sessions, the stock is up 43%. The buyback size is almost 20% of its overall market cap. And today's volumes, the highest in the last 5 months, had 2.5 crore shares that have been traded on Nectar Life Sciences today, compared to a 20-day average of around about 11 lakh shares. But the stock has been an underperformer. It's almost halved in 2025 so far, despite this 40-odd% move that you have seen in the last 5 trading sessions. Lakshmi Dental is the other mover today. It snapped an 8-day losing streak, 7.5% higher on the stock. The volumes today, the highest in 3 months. 23.5 lakh shares have already been traded on Lakshmi Dental today, 20-day average of just around 61,000 shares. The stock had hit a 52-week low today itself in early trading of 244, and then it has staged a bit of a rebound from those levels. And from its 52-week high, which is well over 580, the stock is down almost 60%, and from its IPO price of around 430, the stock is down 40%. Lastly, Hindustan Copper, metal stocks continuing to do well on anticipations of rate cuts. Of course, copper price is also being at record highs, the top gainer on the Nifty 500 today. The stock is up in 4 out of the last 5 sessions. Over 1 crore shares have been traded here as well. The 20-day average of around 32 lakh shares, so close to triple its 20-day average. The stock took support at its 50 DMA at 335 and has rebounded from those levels and has had a pretty good year as well so far. The stock is up around 42% on a year-to-date basis.
All right, Hormas, thanks very much for bringing us up to speed with what's buzzing. But the big story today, that, major airports across the country are facing a lot of disruption following IndiGo flight cancellations and delays. The DGCA has summoned IndiGo over flight cancellations and delays. And to give you some context, more than 1,200 flights have been cancelled in just the last 1 month, out of which 755 were cancelled because of crew FDTL, which is, flight duty time limitation, the new norms that have come in expiry chaos across airports, because passengers were left stranded for hours on the back of that, leading to long queues, rebookings and last-minute rescheduling. Now, Captain M.R. Wadia, who's the founder president of the Federation of Indian Pilots, is joining us now on the show. Captain Wadia, thank you so much, for being here. How do you assess the current situation at IndiGo? Is it a, manpower management failure, or is there a deeper issue here with pilot fatigue that perhaps plagues the wider industry, not just IndiGo?
It's not only affecting IndiGo, it affects all the airlines. And there's a very significant fact that most people are not aware of. That is, the safety comes first. The flight and duty time limitation, the DGCA has constantly played around with these figures. These flight and duty time limitations are not mandated by DGCA. There are research done on the subject on daytime flying, nighttime flying, and the FDTL is mandated by various international organizations. Here, unfortunately, in India, very often the commercial aspects takes over or supersedes safety. Flight and duty time limitations are not for the benefit of pilots, not for the luxury or relaxation, but it is essential to safety of flights. Therefore, this cannot be meddled with. And if today the pilots are not available because of FDTL, it is perfectly okay. You cannot compromise on these figures at all. So no one is to be blamed for that.
So what happens next, Captain Wadia? Because, on the one hand, there are a lot of passengers who need to get to places. On the other, there are airports which are bursting with people outside. And then there is a fair amount of uncertainty. The DGCA has been asking for clarifications, and then there is this issue that we're talking about. How does this...
Very good question. Just repeat that question in your own mind again. What most people are bothered about is inconvenience to the passengers, inconvenience to the flights, inconvenience to the airports. But do you consider the safety comes first? And any amount of inconvenience cannot proceed or take over mandated issues of flight and duty time limitations. So safety cannot be compromised under any circumstances. So if airports are crowded, the passengers are delayed, they have difficulties, there are ways to circumvent these problems by inducting more people if required, having sufficient crew and aircrafts available so that the flight and duty time limitations cannot and should not be compromised at all.
But were they being compromised? I'm just trying to figure out, because there hasn't really been any incident, etc., right?
Oh, yes. Many incidents also. And some airlines, when pilots have asked the airlines that they're compromising on flight and duty time limitations and insisted on safety, those pilots have been even sacked from the airlines. There are enough evidence. Don't ask me for details because that's not necessary, but that is an absolute fact. Pilots have been sacked, engineers have been sacked, many crew who have pointed out the faults or pointed out safety compromises that the airlines do have actually been sacked. That is the important part of it. You cannot compromise on safety.
So, Captain Wadia, in that case, there have been such standoffs in the past as well. But every time incidents like these happen, then they are resolved and then people end up forgetting about them. What needs to be done to ensure that this does not happen in the future? Because at the end of the day, the pilots and the airlines continue to squabble, but it is the end passenger that ends up suffering.
The pilots and the airlines do not squabble at all as far as flight and duty time limitations are concerned. The pilots are not asking for some luxury relaxation or off time or holidays, etc. What they're insisting is that the airlines must, because the pilots realize the importance of safety. Most of the DGCA people as well as the government do not realize the importance of safety. Please understand, today the DGCA has a few technical people, but some years back, when I started this Federation of Indian Pilots, can you believe it, that DGCA did not have even one aviator in the whole office of the DGCA. Not one aviator. And therefore, they do not understand the importance of flight safety. Now that things are slightly improving, but they are not what they should be by international standards. And if you have international standards, you will have far more reduction in accident rates. So safety is important first.
But how are our accident rates versus the world right now, sir?
Don't ask. I have the figures with me. Don't ask for figures because...
It would help to have them, Captain Wadia, to put some perspective into this conversation, because safety, of course, is of utmost importance and no question about that. But
the government and the DGCA themselves have given figures which are not complimentary at all. But let me give you some figures to understand the problem. See, the world accident rate is on an average of 1.5 hull losses per million departures. And this figure has plateaued out for many years because it's very difficult to reduce it. Earlier, this rate depended on pilot error also, or human error, as well as equipment error. Now, the equipment error has been resolved quite a bit. From about 80%, has come down to below 20%.
Sure.
But in India, let me tell you, the countries that enforce safety and have independent safety boards, their accident rate is 0.4 to 0.5 hull losses per million departures, where the world average is 1.5. And India's figure used to be very high. It is slightly better now, and the government and the DGCA have given figures on their own also,
Well,
which
Captain
is not...
Wadia, just to wrap things up, for an airline like IndiGo, what are the non-negotiables over the next, say, 24 to 48 hours that must be done to stabilize operations, given the current situation?
Whether you're talking about 24 hours, 48 hours, or 1 year, or even 10 years, flight and duty time limitations are based on aviation safety only, and that can never be compromised, even if your passengers are inconvenienced for 24 hours or 48 hours. In the past, DGCA has given dispensations to flight and duty time to accommodate inconvenience to passengers. Now, who's monitoring this figure given by DGCA? And DGCA is not authorized to exceed this flight and duty time limitations, whereas they make their own laws, own rules, and say, okay, this is the flight and duty time limitation in India. They are done by a lot of research.
Captain Wadia, thank you so much for sparing time and joining us to shed light on this important issue currently plaguing the aviation sector in the country, with chaos across airports with flights being cancelled by the dozen. Take a short break and of putting the focus on the crypto markets on the other side. Manisha Gupta joins in. Welcome back, and shifting the spotlight to the crypto markets where some stability is returned over the last 2 days. Manisha is here to tell us more. Manisha.
Oh, well, absolutely. That's the reason I'm not looking at prices right now. But I do want to tell you on what the cost of mining a Bitcoin really is. And that clearly has been very, very volatile in the last many years. Let me take you through, first of all, on the various costs that are involved when you are mining a Bitcoin there. So the first one and the most important one clearly is the electricity cost. So nations with subsidies or low cost power have lower mining costs. And that is pretty evident on what countries basically can work into this one. The other cost that you have to take a look at is about the hardware. The modern Bitcoin mining requires powerful, energy-efficient, application-specific integrated circuit rigs. The third thing to watch, of course, is the other operational costs. So you have the cooling systems, maintenance, and of course, the fees of joining a mining pool, because individual mining clearly is not profitable and not feasible as well. And then it also is about network difficulty. As more miners join in, there is more computing power, thus reducing individual profitability there. Bitcoin halving is another important one, because as and when this happens, and it happens every 4 years, by the way, the last Bitcoin halving was in April 20th, 2024. The mining rewards within this halving were reduced from 6.25 to around 3.12 as per block. So that also reduces your profitability wherein. And then you have other factors as well. For example, you have Bitcoin mining revenues, you have structure within, mining difficulty adjustments, and the Bitcoin price itself, which has been very volatile. So we've seen an all-time high of $126,000, and we are trading at around $89,000, $90,000 at this point in time. So the cheapest mining that you can do for Bitcoin is in Iran, and that is majorly because of the electricity cost there. So one Bitcoin can be mined at $13-20. Huge profits clearly, because we are trading at $90,000. And then you have Cuba, Libya, which also have mining costs to the tune of $3,900 to $5,200. Bahamas within US is very expensive, $280,000. Bitcoin price is at $90,000. So clearly not profitable. And the most expensive place to mine a Bitcoin is Italy at around $306,000, with Bitcoin trading at $90,000 right now. So there are a few countries which are absolutely not feasible or profitable to mine Bitcoin therein.
All right, Manisha, thanks a lot for that. Italy expensive anyway, but if you're mining Bitcoin out there, it will be a lot more expensive. 3,06,000 is
3 lakhs.
Wow. Well, on that note, what we'll do is just take a short break, come back, discuss market technicals with Jay Thakkar of ICICI Securities, something that we understand a lot better than Bitcoin. Well, trading hour continues, and from the F&O desk at this hour, what we're getting is good news from the market. We have the Nifty IT, and the Nifty Bank, all of them doing well, though there has been a smidge of a decline from the Nifty, for the Nifty Bank from the highs, so currently sitting with a gain of almost 50 points. But from yesterday's low, it has seen a strong recovery as well. The top contributor to the Nifty on the way up is Reliance today. The stocks moved to the high point of trade as we speak, around that 1,560 rupee mark, and all of this with a declining VIX bodes well for the bull. So the India VIX is down by about 1.5% as well, closer to that 10.96 mark, just below that 11 mark. And the market breadth too, firmly in favor of advances. So we have a fair number of stocks, almost 1,700 stocks in the green for about 1,000 stocks which are in the red. So, the lines are firmly above, the green line above the red line. That comes up for you on the screen. There you have it. And as far as the options are concerned, 26,000 put has been fairly well written, telling you that the support for the market is around that 25,950 thereabouts, a little over yesterday's high, and 25,950 is also the 20-day moving average on the Nifty. The up move can also be attributed to the short covering that we're seeing at the 25,950 call. As we see, the open interest is down, the premium is up by almost 33 rupees. So there is short covering that has led the market above this 26,000 mark, but not much beyond 26,100, because that's where bears are still fairly active. 26,100 call has a premium of almost 100 rupees. So that's telling you between 26,150 to 26,200, there would be some supply, which is close to today's high as well. So we'll watch out for that. So by and large, the range on the Nifty, 25,950 to 26,000 is the support, 26,100 to 26,150 is where the resistance lies.
Interesting, Mangalam. Thank you for that update there from the F&O desk, taking the conversation on the markets forward with Sumit Rora from Smart Sun Capital. Sumit, good morning. Thank you for joining in. The rupee depreciation has been a big talking point, and the IT stocks, as a result of which, have seen a very, very smart rebound over the last couple of trading sessions. But do you believe that this rupee depreciation would be enough for a margin boost? Yes, but for this quarter, at least from what a lot of the companies have mentioned, things on the ground have not changed quite materially.
Absolutely correct, Hormaz. Thank you for having me on your show. I completely agree. I mean, the rupee depreciation has become more of a issue in everyone's mind today, and sentimentally, it is kind of giving an uplift to the IT stocks. But also on one side, if you look at it, you have the IT stocks which are offering a yield of about 2-3%, and these stocks actually haven't performed, if you see, over the last maybe 2-3 years, because the earnings has been quite muted. So I think that this is more like, just a catch-up play. But, coming to the bigger picture, which I really think is that, the way I see it today, you've got two parts of the market, right? I mean, you've got one part of the market which is offering you, excellent earnings, fantastic dividend yields, very high ROEs. And you've got the second part of the market, which are, all the new IPOs coming. Now, my only point is that if you just go back a bit, look at markets over a 5-year period, I mean, the public sector stocks in India have done very well. I mean, just let me share some data with you. I mean, the matter of fact is that, the earnings of public sector have grown from 1,10,000 crore, to about 5.5 lakh crore. And my assumption is that this is going to grow, higher than the nominal GDP. So, you're going to have the sector growing at at a cumulative profit of 6.5 lakh crore. And today, these companies are trading, at a single-digit multiples. So, I also want to, highlight this to you and your viewers that, if you just do a comparative analysis of Nifty and you see the PSU stocks, I mean, the PSU stocks have given 34% return versus the Nifty of 15%. This is, I'm talking about post-COVID era, okay? And the earnings growth has been 5x. So, I clearly believe that, you're going to see another leg of public sector stocks rallying up. And maybe the catalyst could be very around the corner of the Russia-Ukraine war ending, or, you'll have, maybe some catalyst. But, it's clearly seen over the last 5 years, public sector has been dominating the market in terms of returns and earnings.
But we saw some disappointment, Sumit, coming in yesterday after the government said there's no plan to really hike that FDI stake in public sector banks, on the back of which we had seen those stocks rallying, since October. How do you play that from here? And also the big monetary policy tomorrow, Street seems fairly divided so far on whether there'll be a pause on the back of what's happening in the macro environment, or RBI will use the headroom to cut.
Yes, absolutely. So, I mean, I completely appreciate the fact that, that the announcement yesterday was made. But, I mean, today, look at on one side of the equation, you have to look at, what market cap are you paying versus what profits is your underlying asset generating. Now, today, if you look at SBI, right, SBI reports 80,000 crore profit. Okay, and it still trades at a fairly, P, which is at a big discount to, the index of Nifty. So the point is that, agreed, you don't have, great news flow, but all the same, look at the asset and look at the price you're paying for it, right? I mean, today, just to tell you, in sum total, the total public sector market cap today is 64 lakh crore, and their earnings current year is going to be 6 lakh crore. So you're only paying 10 times for cumulatively 64 stocks. Okay, so the valuation comfort is very much in your favor. Where I think your risk reward is, much in your favor. I mean, you can see over the last maybe 4 years, the defense stocks went up, 5x, 6x, 10x, right? Now, today, I'll give you a simple example. A company like Indian Oil, okay, they will report a profit of, say, 30,000 crore, which is equal to the profit of the defense sector of India, but it trades at a 2 lakh crore market cap. So, you have public sector stocks where, there is absolutely inherent value, which have still not been, captured by the market, is the way, we look at it.
What do you make of the valuations of the new age companies, the recent IPOs that have come in?
Now, that's the whole point, right? I mean, when you buy companies at 7 times, 8 times, 10 times sales, I mean, what is your upside? Whereas, if you buy companies at 0.3 times sales, also, going to the same consumer, what is your upside? So that is the question, which you need to ask yourself is that, what are you paying for? What are you getting? So today, you have companies, in the new age space, you have companies in the oil marketing space. So, you're ultimately serving the consumer, right? And the thing is that on one side, you're paying 0.3 times sales, and one side, you're paying 8 times sales. So now, as an investor, you have to decide, what is your payoff? What is your risk profile? Are you happy with the dividend yield? Or are you not happy with getting paid dividend for the next 20 years? So that's the call an investor makes. But in this side of the market, you've got very high safety. And, you've got divergent views from, several, analyst community, which keeps the valuation suppressed.
So make your point, Sumit. Thank you so much for that. We'll, have another conversation another day. For now, the street would, look at PE and also divide that by growth and look at the PEG ratio for looking at PSUs as well as these guys. But take your point. Dividend yield, yes, but capital gains is the other thing that everyone will be looking at too. Take a short break, come back, discuss market technicals with Jay Thakkar. Welcome back. Let's look at MCX. That stock's actually fallen fairly off the highs, currently at the low point of trade, as our colleague Yatin from Awaz has picked up some developments in the company's weekly expiry nod. Yatin, tell us what you're picking up.
Well, SEBI sources are indicating at this point in time that MCX's proposal for weekly expiry of certain commodity contracts, that probably proposal stands rejected. As of now, the regulator feels that there is no requirement for commodity weekly expiry, especially on contracts of gold, silver and crude. MCX earlier had approached regulator for, approving the weekly, expiries on several contracts on commodity derivatives. However, SEBI, in the past few days has asked the exchanges in commodity as well as certain brokerages to submit last 3 to 4 year client data, which needs more analysis. If you know that in equity derivatives, SEBI is already analyzing data with respect to retail losses, especially on weekly options. And the regulator is right now concerned that if weekly options or contracts are launched in the commodity markets, retail losses could mount further, adding to the concerns that regulator already has for equity exchanges and equity derivative contracts. So clearly at this point in time, SEBI is not in favor of getting weekly expiry contracts for MCX on several commodity contracts, and the regulator additionally has asked for data points so that it can take a decision whether or not to allow those weekly expiries or further improve the market so that the retail losses or the retail speculation also, apart from equity derivatives, reduces in the commodity derivatives.
Just from a stock standpoint, Yatin, I wanted to ask you, the stock is down about 1%, but getting this nod would have been a bigger positive than not getting this nod is a negative, right?
Yeah.
So see, right now, the markets for M6 is, quite buoyant in terms of the kind of volatility that we have seen in gold, silver, crude prices. That is probably supporting volumes. But probably with weekly options and weekly derivative contracts on commodities, M6 volumes could have seen a surge. Probably this is a setback in the short term. But as I mentioned, that the regulator first wants to analyze the data, wants to look at how retail is speculating in the commodity markets and probably then take an informed decision. And, a few days back, SEBI chairman also said that, with respect to weekly options also in the equity markets, SEBI is analyzing data. And once that analysis is done, they will probably look at, launching some discussion papers. Similar things could happen in the commodity markets as well. But yes, as you're mentioning, probably M6 could have benefited with weekly contracts on gold, silver coming in at this point in time.
All right, Yatin, we're going to have to leave it at that. Thank you so much for joining in with that story. We'll move back to the markets then. Jay Thakkar from ICICI Securities joins us for a quick technical check of the market. Jay, markets in the green, what are your top picks at the hour?
Hi, good morning to you, Ritu and Mangalam. Well, see, as far as the index is concerned, I think it's going to be pretty much range bound between the levels of 26,300 Ritu and 25,800. In fact, we had a good rollover from November to December series, and we saw that FIs almost shared almost 50% of their index short positions, and it had fallen from 180 lakh contracts, 1.8 lakh contracts to almost 90 to 95,000 contracts, and it even dipped to 87,000 contracts. But then that was just one day move. What happened is post the expiry, the December series started with quite a positive note with 300 points on Nifty. But thereafter, we have been seeing that it's been, slowly and gradually sliding towards this, the previous month's VWAP of 25,800. It has taken a good support there now. So 25,800 from here on, Ritu, I mean, we have 26,000 put option base as well. So 25,800 seems to be a very crucial support, and 26,300. I mean, multiple times we have seen Nifty, making those lifetime high, but then unable to close about 26,300, and from there is where we have been seeing supply. So that clearly indicates a resistance. So I think that Nifty is likely to trade within this 500 points range unless we get a meaningful breakout from this range. There is going to be quite much of stock-specific momentum, and within which we have seen Nifty IT outperforming the overall Nifty as of now in the short term. So I've got emphasis on the buy side from Nifty IT. I think that emphasis is likely to inch towards the levels of at least 3,100 in the near term. On the downside, 2,800 now will act as a very critical support. We have seen some good short covering happening there. There's been almost 1 or 2 quarters of consolidation, post which we have been seeing this breakout happening. And overall, IT sector is witnessing short covering. So emphasis is my top bet from here in the short term, and second would be on Hindustan Zinc. If this stock is likely to inch towards the levels of 535 to 550 in the near term. On the downside now, 485 zone seems to be a critical support. We have seen silver moving up quite sharply again, and that is one of the reasons also Hindustan Zinc is trading higher. But apart from that, we have seen the global metals overall are rallying quite well, and Nifty Metal or Commodity Index recently have done quite good. We have seen good long build up there as well. So both technically as well as from the derivative point of view, from the global point of view, I think Hindustan Zinc also looks quite positive in the near term. So these are my 2 top bets as of now.
All right, Jay, and thanks very much for bringing us those updates. On that note, we're going to have to take a very short break, but when we return, we'll get a quick check of the markets and, of course, get the management of Bikaji Foods. So stay tuned for that.
Welcome back. You're watching us here on Halftime Report. The Nifty Bank, as we pointed out, has now moved into the red. We have the Nifty 2, which is currently holding with a gain of just about 40 points. From the highs, it's down about 50 points. So just watch out for the markets as we move towards the next hour of trade. There has been a bit of a decline from the highs. But the stock on our radar is Bikaji Foods International. The management joining us today. Obviously, we have the Chief Operating Officer, Manoj Verma. We talk about the festive season demand update, raw material environment and expansion into newer markets. Thanks a lot, Mr. Verma, for joining in. In the third quarter conference call, you had said that you are expecting 14 to 15% sort of volume growth in the third quarter for your ethnic snacks business. The first half of this year, your volumes have been a shade under the double-digit mark. For the full year, what targets do you have? And what you had said after the conference call, has that actually played out in real life?
Yeah, so we are staying exactly for what we said. So quarter three, would be a good quarter in terms of our volume growth and would be around for what we said. Overall, if we look at it, our full year performance, it will be a double digit or a close to double digit growth, volume growth in terms of what we say.
All right, Mr. Manoj Verma, your revenue mix heavily skewed towards ethnic snacks, and you've spoken about growing in mid-teens to high teens in the third quarter. But for the full year and maybe a 1 year ahead period, how do you see this revenue mix evolving? Do you expect some of the other categories to go faster?
So the biggest part is the ethnic snacks, which is about 70%, which comes from the ethnic snacks itself, and that's where the most of the focus is. Other than this, sweets is also doing extremely well, but again, it's more of a seasonal product, and the efforts there are to how do we make it round the year kind of a stuff. So over a period of time, you will see that sweets will also be performing well and will gain the share of business of our entire portfolio.
Manoj, you've mentioned that you continue to target, I beg your pardon, what kind of revenue share are you targeting from your core and focus markets going forward, Manoj?
So core would be around 12-13%. So growth, that's the growth. So core currently, if you look at, is upwards of 70%. This would come down to around 68% kind of a share of business in our stuff. And the focus would move towards 18%. The rest would be exports and other markets.
All right, focus moves to 18%. Just to reconfirm your guidance, because earlier you had said that you are looking at low teens volume growth every year. This year you will be doing close to double-digit volume growth. So that's a decline from what you had guided earlier, right?
So volume growth, of course, would be, but so what we said more on the revenue growth would be mid-teens, and what we said we'll stay on that stuff.
Okay, mid-teens revenue growth, and margins in the second quarter were 15.4%. That was a 5-quarter high. That continues to stay. Last year you did margins of what? Close to 12.5%. This year you would be around the 15% mark?
Exactly. So inclusive of PLI, this would be the margins we'll have.
All right. What about, your increased investment in the US subsidiary? And my colleague here, Ritu, traces her roots to Lucknow, whereas I come from Bikaner. Bikaner is the land of bhujia, and now you are moving to UP as well. So both on US and UP, if you could give us your sense.
So let me take your first question first on US. So US are continued investment and focus on international or exports business. That's the kind of investment what we have made in our US subsidy. This is primarily on our stocks, the credits what we give to the business partners there and in the sales. So that's what is the investment, and this was must or is essential to grow this business in the US market. That's the point of this investment made. On the UP stuff, UP is the largest consumption market for traditional ethnic snacks, and that's where we are focusing. Keeping that in mind and walking the talk on is we say that our investment in marketing. So earlier, a few months back, we rolled out a campaign for our core markets, and the tagline was Bhujia Ho To Bikaji. And for UP, we've roped in Pankaj Tripathi and with a tagline of Kya Baat Hai Ji. So this is what it is. It is a 4-month campaign which kicked off on the 1st of December and will be there for 4 months.
So how much does your revenue come from UP right now, and how much do you expect this to grow?
See, it's a slow burn. When you make these marketing investment, they are for future. So it'll be very difficult or unfair to expect that over a month kind of growth if we look at. But yes, what we see is that the UP would be delivering 25% growth year on year, or in fact maybe more. That's what we're looking at.
But given your UP growth aside, your large investment in your US subsidiary, exports still about 6.5% of your sales. Some tailwinds from the weakness in the rupee. What sort of growth are you expecting in those markets?
So if you look at quarter 1, quarter 2, and even now YTD quarter 3 also, if you look at, so exports would be growing by far high in that stuff. So there's quite a momentum. As we spoke earlier as well, that we have made investment. I mean, while this is one capital investment, other than this, we moved our head sales for who was India. Head sales is moved to US and will be looking after US and Canada market, where we see a huge potential, and we would be, putting our might behind to build those markets.
So can you give us a number? 6.5% of sales is where you're at for exports. How much do you want that to go to?
So let me correct. It's not 6.5%. It's between 6.5 to 4%. That's the contribution of export sales.
Sure.
It's a small number. The contribution, if you look at being a small base, will not move as much high because we expect good growth from our domestic markets as well. But eventually, over a period of time, we see that this would move up to 5% as well. And in terms of growth in exports, we will look at, say, around upwards of 40% growth for next 3-4 years.
All right. Just a final question, Mr. Verma. I'm looking at the promoter stake of the company. December 2024 was 74.98%. March came down to 74.92%. September, 73.92%. Two promoters in particular, Shivratan Agarwal and Deepak Agarwal, have been paring their stake a little bit, about a few basis points every quarter. Does that continue? Is there a promoter block which is likely?
No, that's not. I mean, so this was to create some funds for family office. That was the sole objective of this dilution.
And the family office has created enough funds now? No more selling?
Not for now. I mean, so there's enough and more to invest, and then maybe at a later date. Not for now. Cards.
All right, take that point. Thank you so much for joining in and giving us clarity on that. We take a short break. Come back. More on the markets on the other side.
Expiry related volatility playing out, 80 points off the highs of the day now for the Nifty, heading back towards that 26,000 mark on the downside. A couple of stocks to mark before we close out the show. BSE is one of them. It continues to fall from the highs of the day, around 2,700. 2,800 was the day's high. Is now around 0.4% higher, but off the highs. What has seen a bit of a spike though, as these Mumbai-based real estate players, be it Lodha, be it Godrej Properties, they have moved higher, and of course real estate as a pack itself is doing well for itself before the RBI policy decision tomorrow. Some spike coming in for Godrej Properties and for Lodha. The real estate index has seen a bit of an up move, 0.75% higher. And just pull up two names before we call time. Swiggy is one, moved back above the mark of 400. Reports coming in of a QIP launch next week. And Eternal, that has now moved below the mark of 300. So it's a 4-month low for Eternal, has not closed below levels of 300 since August. So take your leave on this edition of Trading Hour from Mangalam, Ritu and me. Thank you for watching. Halftime report on the other side.